Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doe.
And look like you're frozen, Dope. Are you with us? Yeah,
I
you
think so. Can you
frozen,
hear
Dope.
me?
Yeah, we
Okay, I'm
kind of
about
sparingly. Yeah, you need to get out and come back in. So, everybody, welcome here, and so glad to see everybody. Let Dope get his stuff together there for a minute. He'll check out and come back in. We are the FITT Show, helping people get their finances in order, in shape, and we try to come to you every week. This is our 197th show, believe it or not. And we definitely are here every week, Thursday at 8 p.m. Okay, here's Dope trying to come back in on another. Okay, we have a little bit technical difficulty with Dope here. Hey, Dope, I got you up here twice. Here we go. Are you there, Dope? Okay. Hey, Dope, how you doing? All right, we have a little technical difficulties right now with Thomas Doty. Hey, Dope, can you hear me? Okay.
I can hear you. Can you hear me?
Now I can hear you, just can't see you. Now I can see you. I can hear you.
Okay,
Yeah.
I think we're good.
Yeah, you frozen though, but that's okay. So anyway, let me
Still
continue
frozen?
on. No, you in and out for some reason. And yeah. So anyway, so look, y'all, let's get the administrative stuff done first. Please make sure you understand that we're not investment advisors. We are financial educators, and we provide information that you can use, general information. We're not selling any products. Just want to make people know that, so we're not compromised by giving you information. Other thing we like for you to do is to click on the like button, because that's where, and the heart button, where we get a lot of traction. That's how Facebook at least works. And make sure you go out there and share on Facebook Live, and also subscribe to YouTube if you're using YouTube. We really appreciate that 100%. While Dota's getting this stuff together, we also want you to put comments, or if you have any opinions, or it's our way to interact with you. Use that comment box, and because it definitely works that way. And hopefully we got Dope back here.
How does it sound now?
Perfect. Yes.
Yeah, I switched the Wi-Fi setting and see if that works. I'm in a
Yeah.
hotel.
Oh no, you perfect right now. Perfect. Okay, good stuff. Dope. Welcome, Dope. How you doing today, man?
Good to be here, man. Good to be here.
That's good. Glad you're here. I just went through the administrative stuff that we normally do, and that's it. Make sure, like I said, please put stuff in the comment box, because that makes us reach even more people for some reason. That's how the algorithms work. Last week was tariffs in your wallet. We hope that was good information. Remember, up to 30 days shows that we've done, because they got a new thing on Facebook now. They're not storing all the shows. But if you want to catch last week's show, which was very good, some really good, interesting tips on how the tariffs are going to actually affect your wallet, and a couple of other ones from the weeks before that are still out there. Go out there in the archives. You can see them on Facebook, and you can also see them on YouTube. So, Dope, what's that? With saying that, man, how is the market doing today?
The market is really, the guy who's running the country is really manipulating things. When some good news comes out, stock market goes up. When he says certain things, the stock market goes down. This past week has been pretty eventful. You can see you got your stuff working today. That's a good thing.
Thank God. Yes.
Yeah, you can see the S&P is up, which is always good. It's only up about 1%, but it's always good when it goes in the right direction. NASDAQ is up 1.2%, 217 points. Microsoft had a big jump. Okay, it's up 3%. It's up to 438. And that's mainly because they had a gangbuster first quarter, and a lot of the growth in their cloud business has really caused their stock to take off. And the excuse me, and the cloud business is going crazy, and a lot of analysts are upping their price targets. So it's on the move. It's doing really well. Apple, on the other hand, took a big hit. You can see it's down 13 points. And that's mainly due, they had a okay quarter. It wasn't great. It beat by a little bit, not as much as as the market expected. And it shows some weakness in China, which is one of their big markets. And the other thing, everybody got a little nervous because a year ago they had announced a $110 billion stock buyback, but they lowered that to $100 million. And so that caused a little bit of concern.
Hey, Dope, how does the stock buyback work?
That's when a company buys its own stock, which typically causes, if you think about it, earnings per share. If you reduce the number of shares, that's going to cause that earning per share to go up. So typically, it's a way to drive the stock market, the stock of the company back up by taking shares out of the market. Okay, reducing the number of shares, which usually causes the stock value to go up. And so they aren't buying back as much as they had anticipated, as they'd announced a year ago. So that caused people to get a little nervous. NVIDIA up 5 points for the week, about 4.5%. The other big drop was in Google. Google's taking a big hit, and it's mainly because Apple announced that a lot of people are using AI to search instead of Google. So that kind of caused some concern that Google may not be the primary search engine in the future, but we'll see how that all shakes out. And Pfizer dropped $1, nothing unusual there. And that stock Palantir, it's been up and down. It took a big drop when they announced earnings, even though they beat. I mean, they're up like 36% over last year. So the stock took a big hit, then it came back, and now it's continuing to go strong. As I told you last week, since I think January 17th, that stock has gone up more than any other stock in the S&P 500. So I'm still holding on to that one. So all in all, I mean, the market went up today supposedly because the US and the UK have reached the trade agreement on tariffs. And I think they reduced them on some things, but they're still going to keep that 10% tariff. And I'm just amazed that nobody's really coming out and saying that this ain't going to work. Just right. Adding tariffs across the board. There's no economic substance behind it that says that's going to cause things to go up. I think it's a push to try to get more production here, but realistically, a trade agreement is something that two people negotiate and agree on. So nobody's taking advantage of anybody. You do a trade agreement, it's an arm's length transaction. You give me something, I give you something.
Right.
And so this thing is going to continue to be a problem because it's going to cause inflation. Because in its simplest form, a tariff is nothing but a tax. Somebody has to absorb it. And so I just don't see how this is going to work. And we'll continue to see how it shakes out.
So, so with that, that uncertainty is what has the market. I'm talking about everything from bonds to commodities to, everything is in limbo and no one can really figure the direction. Normally you can't, figure what it exactly would be, but at least they can predict the direction. Was it going up? Was it going down? They don't even have a clue. But just want to say gold, though, it went down, but it's back up to $3,325 an ounce. And silver's up to $32.65 an ounce, which is pretty good. The bond market, though, because, we believe in having a diversified portfolio, the 10-year bond market, they holding at 4.37%. And that's, that's pretty good because they only federally taxed, right, Dope?
What's that?
Bonds.
A lot of bonds are not taxed on the state level.
Right. They're not. I had it
Yeah.
backwards. Right. That's I had it right. They tax on the federal, right, and not on the state. So that's still a good deal too, And the high yield savings accounts are hovering around, 4.5. You can get a 5% one, that's insured by the FDIC, and but with the Fed Reserve talking about lowering the rates one more time this year and two more times next year, those rates are definitely going to go down. And so if you're trying to, get the best of some of those rates and having lower risk, you might want to think about at least getting the best of that high yield savings account now, or possibly locking it in to a CD, and that way it won't go down. But, we'll talk about that later. The cryptocurrency market, though, is rolling, and I have a mistake there. This is actually 200, and I think let me correct this. I don't like to have wrong information there. Hold on for a minute. 3116 equal that. Right. Okay. It's 20 is about how much is that? Wait a minute, hold on though. I'm sorry. I'm losing my train of thought here. Hold on, just want to get this right. 3116. Yes, it's supposed. I left out a one. It's 212 billion, as in billion, is where the cryptocurrency market is increased to. Well, I knew that was wrong. I left out the one. And it's up 7%, and that's a lot. 212 billion, the whole cryptocurrency market. And look at the Bitcoin. The Bitcoin, I think last week it might have been 4,000. The week before that it was about, I think, 6,000 to 7,000, and this week it's up $6,626, up 7%, up to $102,937 per Bitcoin. Earlier today, it was up as much as 105,000. Remember, this is Bitcoin. I mean, cryptocurrency is priced 24 hours. So this was I did this was at 7:30, so it could change, but that's a good return though.
Yeah, I told you I'm up about a factor of 5. I've done really well.
So
with a little bit I bought,
So you said a little bit. How much did you put in, and what is it now?
I only put in like $4,000, and it's up to like 22,000.
Good googly moogly.
Now that's and also when I did my Roth IRA separately, I put another 8 and 8, 16 in the crypto, and I got in there at 84, and like you said, it's up over 100 now. And so I picked up about 25% on that 16. That 16 is now worth 20.
So, I put in 2 though, and I forgot what it was around, maybe 79, something like that, and it's worth now 4,500.
Yeah.
So just give you an idea. Like you said, it's been volatile, but like if you got a place for it in your portfolio, you can possibly make out. The thing about it, you all, it's all about the long play. Don't forget that. The other ones everything is up except Tether, which is tied to the dollar. It's down, but every other cryptocurrency. Look at Ethereum though. The contract cryptocurrency is up 18%.
Wow,
that's a lot. That's a good return. But most of them rate around 7%. Binance, Ripple, and Solana, and so it's a good return. So if you have some money, excess money that you have,
you got to come up with another word of ain't no such thing as excess money.
Excess money.
You got some money. How about money you can afford to lose? How about money?
That's what I didn't want to say. I was trying to think of something other than that because that sounds so crazy, but it's the truth. If you got money, and that's another one, who can afford to lose money though? That's why it's tricky.
Well, no, it's not that you can afford, but it won't change your life if it goes down.
That's what I'm gonna say.
That's the money you can put in Bitcoin, money that it won't change your life if it goes to zero.
I'm gonna start with that definition. I'm not even going to use the other ones. Yes, if it's money that will not change your life and you still be able to pay your bills, you might want to consider it.
Exactly.
That's just might.
And that's kind of what we're going to talk about tonight. That's kind of tonight's conversation is looking at your investments and how you work through your money. You save, and even though we always joke that I'm a little more aggressive than Bob, we're probably generally in the same area as far as risk. We both took a systematic approach to investing. We tried to build slowly. We didn't try a lot of risky stuff coming up. And honestly speaking, part of it was because we didn't know or understand a lot of the risky stuff, or we may have taken a shot. So what we're going to talk about tonight is not just, you make some money with your systematic approach, and then you try something out there. You try to hit a home run when you've been hitting singles the whole time. And it's okay to try to hit a home run, but you can't take a lot of money and do that. And so just like we're talking about with Bitcoin, if you want to take a chance on something like Bitcoin, you do it with a small amount. You don't do it with the bulk of your money. You don't risk the bulk of your money. You don't take all the money you've been systematically growing and then try to put a bunch of it into something that's extremely risky, because you put too much in there, and let's say Bitcoin or whatever it is goes to zero, then you're totally wiped out. So you keep your systematic approach. You continue to be diligent in how you invest, and you basically just don't make any crazy wild decisions.
Yeah. Modestine has a couple of questions. Let me look back at them. Modestine, I wonder for, how long are the shows on YouTube? I actually don't know, but I think they're on YouTube a lot longer because Facebook just had this new policy that they hold 30 days, but I think YouTube holds them for a long time. I just don't know how far back they go. Facebook went back a whole year, but they're going to stop that. So, but I don't know. And then Modestine said, tell me again, how can I buy stock shares online? You want to take it? You want to take the note?
Yeah, the first thing you have to do is you have to have a brokerage account, and you have to have some money in that account to make a trade. Now, I say you have to have some money. You buy a stock, you usually have 2 days to settle. So, like a lot of companies won't let you buy stock unless you have money available to trade. You can't just wait until the deal goes through and then pop the money in there. So you open up an account with a discount brokerage, be it E-Trade, Charles Schwab, Fidelity, Vanguard,
right,
TD America. You open
T.
up
Rowe Price.
Yeah, there's a ton of different options out there, and a lot of them have plans that are conducive to new investors. And so read the fine print on that, because a lot of them will offer free stock trades. And so you open an account, you put some money in, you do your research, you find a stock, and just through the app, you just go in and you'll hit a button that says buy, and you pick the stock that you want to buy. There's a couple questions you have to answer. How many shares you want to buy? You have to answer when you put an order in. That order can be at the market price. It can be, I want to buy, let's say Microsoft. I want to buy Microsoft at $4.35, in which case, that's the only price. If it's above $4.35, your deal won't go through. Your sale won't go through. I'm sorry, your buy won't go through. But if for some reason it drops to $4.35 and that's your price, that's the price you'll purchase it at. I've always put all my transactions through at market price, because when I decide to buy a stock, I want to buy it. I don't care what the market's doing at that point. I want to buy it. But you can buy it at a particular price, or you can buy it at market. And there's a couple other situations, but I won't even go into those.
Right.
And so that's how you do it. And then it takes 2 days for it to settle. And by that, I mean, the transaction goes through. 2 days later, they'll take the money from your account and you'll actually own the stock. And that's how it works.
But once that trade is executed, excuse me, you'll get the price the market was at that time the trade was executed. It won't be the
Right.
time 2 days later.
No, it'll be when you execute the sale,
Right.
whatever price it sells at, that's the price you get.
Right. And another thing too, Modestine, when don't say you open up an account, you usually tie to a bank account, or so you can transfer money into it. It's much quicker that way. Or you can go into a physical office and put money into your account. But if you're not going to do that, normally you can do it from your house online, tying it to your bank account. And this, when you want to trade, you just transfer your money, and it normally puts it into like a money market account, low interest bearing account. You can leave it there until you go to trade, and you can do everything online. Now, the thing is, you can do that if you do it yourself. Well, let me just talk a couple of them, especially T. Rowe Price. If you do it yourself, I think, and I'm trying to remember, it's not a cost. But if you use, like you call and use a broker, it's usually like $9.95. That's
Yeah,
all.
most of them are like that. If you do it
Yes,
online, it's typically free.
free.
And the only thing different I do than what you described, Bob, I would if I'm going to open an account with say T. Rowe Price, I'd put the money in T. Rowe Price and save that transaction of having to put the money there. And they're typically going to have a high yield money market account
Right,
that's going to pay at least whatever interest rate your bank is paying. And 99 times out of 100, it's going to be paying a higher interest rate. So
right,
you put it in the T. Rowe Price money market, and then when you decide to make a trade, that account is tied to your brokerage account. And really, I kind of said this wrong, because you're going to have two separate accounts.
right,
One account is a money market account. The other account is the brokerage account. You make the sales transaction, buys and sales in the brokerage account, but you get the money from your money market account. So when you go into T. Rowe Price, you'll see both of your accounts, because you have to have both. You have to have the brokerage account to do the transaction. You have to have the money market account to have the money in there.
the
Okay,
cash.
the cash, right? And so once you make a transaction, let's say you have a brokerage account and you buy 100 shares of Microsoft at 438. So you have $43,800 in stock. Let's say you sell that stock. That money will then be in your brokerage account in a money market account. Okay, so it won't automatically go to the original money market account you had. It'll go to the brokerage account. Now you can bypass all of that by just opening a brokerage account and putting money in there, and then you only have one account. But
Right.
the situation we started off describing with a money market account and transferring to a brokerage account, that's kind of two steps when you can do it in one. You can open a brokerage account and then put money in there so you have money to trade.
To trade, right. And then you can trade it once you have the money and you trade. You can trade that money out of your broker accounts, and normally, and then and buy a stock, trade out, and go into the money market. Then you can purchase other stock. But anyway, I hope that helped. Oh, she said thanks. Good, 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 good. Okay, good to know. Kitty, just right quick. Kitty said the book signing I had you all was fantastic, and Kitty's birthday though was May the 3rd. And forgive me, Kitty. Happy birthday, Kitty. I forgot you. Your birthday was the 3rd, and I missed it. Happy birthday, girl. So with that, so the theme of today's show, right? The theme of today's show is called um, "Look Before You Leap." Look before you leap. Like Doe was, and this is the concept that we're talking about. You know, we make so many decisions, big and small, on a daily basis, but they can't all be taken lightly. We can, you know, we can't just eat our Wheaties because that's what everyone else is eating, or because someone may or may not have been fully trustworthy and told us that this was the best choice for your future health. It's all about thinking, paying attention, and taking on the world in a way where the world won't drop from under your feet because you just haphazardly did things, or you FOMO, fear missing out. Now, there seems to be a recent trend of people doing a lot of listening and nodding their heads, but not taking a good look around for themselves. Now, observation and reflections are amazing tools of the human mind. Now, if you made your decision and you took your leap after making your own mind about all of the facts at hand, that's great. So today we're going to be discussing, you know, taking that leap, taking that move into a different amount of things. But you must really think about it and pay attention. So don't once you start it off.
Yeah, and the first thing you have to do, you got to know what your needs are. Any successful investment strategy is trying to accomplish your goals. Okay, it's trying to have steady, dependable income and growth year after that. And for that, you need investments that are going to generate that growth or that cash. Okay, and so within your portfolio, if you know your needs, you got to have some money available in case you have a major expense, whether it be a big repair or any kind of emergency. You got to have some money available to do that. And we always talk about having a diversified portfolio. That's going to spread your risk among many different asset classes. So as one goes down, you may have something else that's performing pretty well. And so the other overriding factor with your portfolio is you're going to try to minimize taxes, of course, and fees. You never want to pay any more than you have to maintain your portfolio. And so you think about all the different things you can invest in. You can have high dividend blue chips. You can have diversified mutual funds. You can have ETFs. You can have bonds, CDs, money market funds. They all offer some growth and generate income, and they're liquid. And they protect against unnecessary investment risk if you have those things in the right mix.
So the next thing I want to talk about, they call it avoid the shiny ball. The shiny ball. Now, on the other hand, plenty of investment options offer complete opposite. They have high fees, lock up your money, they're complicated to understand, and have high probability of losing money. Surprisingly, investments with these traits can be appealing, and people get the shiny ball syndrome and chase what's in the headlines. Now, people today, they consume more media, especially serious media like the news. Like ads can promote investments that don't make sense. If you're watching the news and an ad comes up and you might assume it's legitimate and vetted by the channel, but it's not. So finally, your lifetime savings could be put on the line, and it could be a target on your back for those trying to pitch you with these great investment ideas, whether from commission salespeople, friends, or outright con artists that are out there. Check this out, though. This statistic shows that people over the age of 60 have lost more than $3.4 billion in investment fraud in 2023 alone. That was by the FBI's Elder Fraud Report. So don't get caught.
And Bob, that's got to be an understatement, because a lot of it don't get reported. People are too embarrassed to say they got took.
Yes.
Those are the ones they know about. A lot of people won't say anything.
Correct.
Okay, the next one, we're going to talk about some of the things that may be okay, but in a lot of cases, they're probably very, very risky, and you should understand all the ramifications if you decide to invest in these things. So we're going to run through a couple of them. One of the major ones is income property. Everybody always says, let's get into real estate. You can make a bunch of money in real estate, and a lot of people have made a bunch of money in real estate because they can, you can generate cash flow, you get big tax breaks, but you tie up a good hunk of your money, and that money is not always liquid. If you need cash, you might be forced to sell when you don't want to sell. And so a lot of times making money in that scenario can be a lot harder than you think. If you try to do a buy and flip, are you going to tear up the floors yourself? You're going to hire somebody? Contractors can be very expensive, and that can eat up a lot of your money. Okay. And a lot of people try to get into rental real estate, and discover how much work it is when you get in those calls at 3:00 because the water's running and won't stop, So they do everything themselves. They don't pay for a management company, and that can end up beating you up. And in some situations, you can get the tenants from hell who can just drive you crazy, not pay you, and force you to kick them out.
Been there,
So
done that.
yeah. So if you've been investing successfully in real estate all your life, then hey, go for it. If you understand all the ramifications involved and you're willing to accept those, go for it. But it's probably not the easiest thing to do if your first time trying it and you're older or you don't have a lot of money to risk. There's other ways you can get into real estate without putting a lot of money in. You could get a REIT, which is a real estate investment trust. And they operate like a mutual fund. So you're invested in real estate, but it's a pooling of money with other investors who then buy property. And so you get some of the investment benefits of real estate with no work involved on your part, and you don't have to invest a lot of money. So be careful about investing in real estate unless you really know what you're doing.
Don't just want to remind y'all the theme of the day's show is look before you leap. And this next one, me and Doe are pretty strong about. We talk about it, but you need to be aware and cautious, and because investors in general, we believe that you should definitely be in stocks, but we talking about individual stocks is sometimes tricky because investors in general should avoid investing in highly concentrated positions, especially individual stocks. We're not saying don't, but you need to be cautious because, should something bad happen to that one sector or one company, it will be highly disruptive to your investments. Now, when you start trading individual stocks, it's harder to control your emotions and not, for example, panic sell after a downturn or too much risk during a bull market, right? Now, mutual funds and ETFs, exchange traded funds, minimize this risk by spreading your exposure across hundreds, if not thousands of investments. They also take the tough trading decisions out of your hands during stressful moments. Now, if you do decide to invest into individual stocks, stick with more established brand name like what they call blue chip stocks or large companies like Microsoft, Google, Exxon. Rather than high risk speculative what they call penny stocks, unheard companies just emerging. You should. And there's a rule of thumb. Once again, whenever we talk about benchmarks, or just a rule of thumb, it's just a benchmark. Because some investors, like from Edward Jones Broker House, they said you should have no more than 5 to 10% of your portfolio in a single stock, and your portfolio should have at least 10 different stocks for diversification. Because I don't know if you remember, Dope, we talked about this before. You can have about 8 stocks and only 2 are really rolling. That can carry your whole investment portfolio. But if you diversify, you could limit some of the risk.
Yeah. The next one to watch out for, and again, these are things, alternative investments are things that someone can show you a perspective and it can detail how well it's done in the past. But these are very, very speculative. These are things like hedge funds, private equity funds, private credit and venture capital. They promote huge historical returns. And the fees can be very high. And again, we always talk about no risk it, no biscuit. Because they can return very high returns, the risk is very high. So you got to make sure you understand what your fee structure is going to be, because there's a bunch of tricky stuff there that it can get you on. The other thing is they require a large minimum investment. Sometimes 100,000 is the minimum you can get in for, and your money is locked up for a year or two. So before you can cash out. And even then you might only get your money back in installments. So it could make sense if you're looking at leaving that money as an inheritance, but it might not be something you want to do if you're just trying to build your base of your investment base. So that's another one you might want to watch out for.
Yeah, that's a good one, Dope. The next one is high risk, high fee mutual funds. Now, once again, me and Thomas Doty are for mutual funds, but you need to be careful because when you buy into a mutual fund or ETF, you pay an annual management fee as a percentage of your contribution. Not all funds are worth the price of admission. It's called the expense ratio that you can see how much they charge it. And if it's a domestic equity fund with an expense ratio of over 1% or international fund over 1.5%, you need to question why. Because if it's over 1%, that's it's charging you the expense. They normally say get an expense ratio fund that's expense ratio under 1.5%. For instance, if it's point five, then that's like I forgot about what $5 or $55 to $50 for every $10,000. Now, either fund, if even though the fund is not performing, or you have an asset under management and it's too small, those fees can be pretty high, and the fund is not performing. So be aware of what they call leveraged mutual funds and ETFs. Now, these funds amplify the returns and losses of a target market index, like the S&P 500. But if they leverage, they might leverage 2 times the fund, and double the gains, or it could double the losses, or it could be 10% market swing, and because it becomes a 20% gain or 20% loss. That's what they call leverage mutual funds. Be careful. And they even got ones that are 3 times the returns. And so be careful, because the upside is tempting. Because just think about it. If you make 2 times, with your gains, that could be like, up to 20% right there. And within a month, you can have a 20-30% return. But it also can be tempting, but it can go the wrong way too. So you can have massive losses. So, that's too much risk when your portfolio doesn't have much time to recover. Somehow he kicked out, though.
Yeah, you kicked me out.
No, it automatically kicked you out. I don't know what's going on today. We got gremlins.
Did you bring me back?
Yeah, you in.
Oh, it still says I'm backstage. Okay. The next one is variable annuities. And those really got to be tricky. Again, you can see they throw a lot of information at you, and they can look very, very attractive, but there's a lot of, it's a slippery slope trying to understand those. Basically, an annuity that's an insurance contract that grows your money and then repays it over a period of time as income. In a different version, you might have an immediate annuity, which you invest a lump sum, and then they give you guaranteed income payments. That's almost like a personal pension. So you might give them $500,000, and they may give you $3,000 a month, let's say for life or something like that. And they're simple to understand, and usually they have pretty small fees. And fixed annuities, they pay a guaranteed interest rate over a set period to grow your money. I actually bought one about 1.5 years ago, because I got a little shaky about what the market was doing. And that's in my money that's professionally managed. My advisor brought it up to me and said, hey, would you think you want to buy an annuity? I think I was paying like 5.5%. He said, because a lot of turmoil going. So I took that and said, okay, I'm going to take, it might have been like a fourth of my money. I took that and put it into guaranteed 5.5%. So I know I don't have to worry about that. So those types of investments could make sense in spite of, not in spite of whatever kind of portfolio you have, it might make sense for you. Where it gets a little tricky is a variable annuity. And that's where the insurance company takes your money and invests your savings in mutual funds. And you can buy riders that say you can only lose X amount, but they are very expensive. Those riders are very, very expensive. The annual fees usually start at like 3% of your balance. And that's a huge amount of money to be coming out of your investment every year. And variable annuities typically lock your money up for a long period of time. And if you cancel early, if for some reason you need the money, they can sock you with a surrender charge that starts at like 7%. So those are, again, very, very tricky, very, very complicated. And you need to be really sure before you take that jump into a variable annuity.
Yeah, and Modestine says no annuities for me, and I feel what you're saying, Modestine. But most of the time, the annuity, well, every investment has a place. Like we use cryptocurrency, every investment has a place. It depends. But variable annuities are so risky because that's why they're variable annuities. Normally, they don't guarantee your principal or the return, but usually fixed annuities, they usually guarantee you the principal, and sometimes they guarantee the interest. But fixed annuities have a place because, like Doe said, if you just want to make sure you get a certain set amount each month for a long period of time, let's say you want $500 a month, then that annuity has a good place because it's locked in. You're going to get the $500 a month. The only downside is, let's say you put $100,000 in to get that $500 a month for the rest of your life. So it might be paying like 5%, right? The only downside is if you took that 100,000 and put it in the market, which like last year it paid 25%, and you can make more, or the lifetime of a lot of stocks, not lifetime, the average, you could have made 10 or 15%. That's the only downside. But the key is, if you just, like Doe said, you want to be on the safe side, annuity has its place. I just wanted to share that extra information, Doe.
Yeah. Okay. The next one is this is on you, Bob Gold.
Oh, my bad. Physical gold. Gold. Now, if you regularly watch cable news or listen to the radio, you hear, and from me, you see ads promoting gold as an investment. And that might seem like an option, especially with gold prices. They're at all-time record highs right now. But while gold bars or coins may look beautiful, and it's so great to have because I have them. They're just great to have. And I want a gold bar. They're much more expensive than the daily gold price quotes you get online. You must pay the dealer commissions. You must pay storage, shipping, and insurance to protect them. If you want to invest in gold in your retirement plan, you need to set up a specialty self-directed individual like retirement account with even more, actually that has some more fees. So, but gold prices can change dramatically, and gold generates no income. You can make money only by selling gold. Now, if you think the price of gold will go up, then do like Doe. Why not put it into a ETF or a mutual fund? And that way you can trade in and out. And this would track the spot price of gold. And you would avoid the fees, the hassle of managing the gold yourself. And if you want physical gold, you should buy some jewelry instead. And at least carry it with you around your neck or around your wrist.
Yeah, you got all those hassles of security. Then when you try to sell, you got to find a broker that won't rip you off. It's having physical gold. I think I told you last year's 2024's IRA, I put into a gold ETF. It's just so simple to do. Okay, the next one is, and we've warned you about this before, this is day trading. And it's one of my favorite Clint Eastwood lines. A man has to know his limitations. I don't profess to be a stock guru. I've made a lot of money on a couple of stocks that I've owned, well, just about all the stocks I've bought, but everything in the market is going up. So it's not like I bought a bunch of stuff and everything else is going down and the stuff I bought is going up. I realize it's not me, it's the market. And that's what you have to understand. It's very hard to beat the market. And even professional fund managers typically don't outperform the S&P. And when you see that, that's one of the reasons why you might not want to invest into an advisor. You may just want to take, let's say you have we always talk about your risk tolerance. And I always say I'm about a 7 out of 10. Bob's about a 5 out of 10. And so theoretically, both of us could take all our money, I'd put 70% in the S&P, and I'd put 30% into, let's call it safer investments like bonds and money markets. Bob would put 50% into the S&P, and he would take his other 50% and put it in safe, predictable investments like bonds, money market, T-bills, and things of that sort.
Less risky.
Yeah, but see, very less risky. But day trading or getting in and out, buying and selling, very, very, very few people make money doing that. I don't know any of them, and it's tough to do. That involves time and includes time in the market. I don't think you want to get into that. That's not a way to build wealth long term.
And I do know a few, because mostly young people that I know that are invade, and it takes doing, excuse me, it takes doing fundamental analysis and technical analysis, and it's real time investing. So, and most of them don't make money, but I know a lot of young guys they get into it though. They they really love doing it. Next one I want to talk about. Remember, y'all, reason why we're talking about these things, excuse me, because I cannot state this enough, you all. If you're not investing, or let me put it this way, if you're not making your money grow, you could outlive your money. And that's why we talk about these things, but you need to be careful before you get into these things. Like we always say, know what you're getting into. I just want to preface that again. Now, let's talk about crypto, right? Now, the Bitcoin broke the six-figure barrier in 2024, but it went back down. It set a record. But look at today, it's back up over six figures again. I mean, up, yeah.
You said it right.
Six figures, right? And considering one coin sold for less than a penny fixed 15 years ago. Now, there are plenty of investors kicking themselves for not getting in early, but that's not a reason to dive into crypto for the first time. Now, cryptocurrencies do not pay income, so you only make money from selling them. The returns are highly volatile. Double-digit swings and losses are common. If you buy the wrong coin, you could lose the entire investment. Now, digital currencies, which is the future, can also be very complex, especially you all. There are now over 11,000 on the market. And that's why me and Dope, we really just report and deal with ones in, actually we showed just the top 6, but we look at the top 10. And they require some specialized knowledge to understand and pick the right one, not because of somebody, your friend, is telling you that if you aren't a technical expert, the hurdles are significant.
Yeah, the next one is starting a business. And that's one that always, people just like the way that sounds. I own my own business. And again, I'm not discouraging that. But again, you have to know all that's involved. If you understood how many small businesses fail, it's a daunting task to start a business and have enough to maintain while you build up traction and customers and avoid downturns or new competitors. There's so many things involved. And again, I'm not discouraging, but just make sure you know what you're getting into. Make sure you prepare a reasonable budget if things don't go the way you expect. And I would recommend that you budget very, very conservatively and make sure you're selling something that people want. You hear a lot of people say, oh, I love cooking for people, so I'm going to start a restaurant. Well, everybody might not like your cooking. It's not that you like it.
Oh, that's funny, though.
No, I'm dead serious, though. It's like you have to make sure you have something that a lot of people going to like. And you see it a lot. I visited a cupcake shop here. A young Black lady opened a cupcake shop here in Charlotte. I'm sitting there thinking, man, you gotta sell a lot of cupcakes to pay rent. I mean, rent in Charlotte has become very expensive. And so you have to understand, you have to be a business person or have access to a business person to make sure you understand all the ramifications involved in running a business. It's not for the meek, it's not easy to do, it's very, very difficult. And a lot of businesses fail in the first couple of years. So make sure if you do go into it, you're ready for the long haul, you got a lot of cash built up, and you're ready to work your butt off because it's going to consume a lot of you. Now, there's a lot of, let's call it self-satisfaction that comes along with running your own business. And a lot of people argue, I'd rather bust my butt for myself than bust my butt for the man. And he makes, he makes all the money off of your effort. So there's something to do that. And so we're not discouraging. We're just saying, make sure you understand the business side of it before you jump in.
And I just want to tell you, if you go on vacation and someone offers you a generous meal to sit through a timeshare pitch, before you leave, pass. Even if the timeshare salesperson says it's an investment, it isn't really. You aren't buying the land or the real estate. It's just a contract to use the property for a few times a year. And getting out of the contract usually means selling for a loss to someone else. And there are plenty of horror stories too of people getting locked into timeshares. Hello, I'm one of them. But me and Tiffany got out without paying in no major fees or anything. And the simple giving the contracts away to stop paying exorbitant, because the things that hit you on those timeshares are those annual fees, and they go up, seem like every year. And what they get you with, though, the plans that we had of the places you could go, as time go by, they go down on the list and you can't get them as much, and they got different places. So now you don't get the same places that you thought you were able to get. That's another one that they don't talk about.
Or special assessments. They have special assessments too.
Oh, those special assessments too. That's another one. So I mean, but if you want it and you find it's a place for you, and now that they got Airbnb though, why would you need to get a timeshare?
Yeah, I bought one too, and again, I think I said before, it's not something I would buy again, but I'm glad I did it because it made me focus on using my points. And me and the kids, the family went to some great places, created some great memories, and I'm not sure I would have had as many vacations had I not had the incentive to use the points that I had paid for. And again, I knowing what I know now, I probably wouldn't do it again, but it's not something I regret doing.
Cool. On you.
And and one more thing, and if you do, make sure you stick to one of the big boys, Marriott,
Yes.
Hilton,
Hilton,
or
yes.
or Wyndham. Stay
Right.
with one of those three because they're not. There are a lot of not. Let's call it. I don't want to say they're not legitimate because they are legitimate, but they don't offer the breadth of options that those three big ones offer. So just be careful there. Okay, the next one is collectibles. I'll never forget when I lived in Detroit, a friend of mine's wife was collecting Beanie Babies and was explaining to me how
that was big.
She was going to get rich off of Beanie Babies, and she didn't. She didn't. And so be careful with things like that, antiques, artwork, classic cars, stamps, and those work for some people, but not for everybody. They don't generate income. They're expensive. There's an issue with storing them and keeping them. If you invest in something like that because it's a hobby, understand it's a hobby and it's really not an investment. And you have to find somebody else who wants that collectible for it to be worth anything. And sometimes that could be difficult.
Dope. Breaking news. You know that lottery tickets aren't a real investment. You're gambling for a small chance for a huge payday, but that's a similar arrangement to many of those investments we even talk about, right? You know,
Right.
now, of course, sometimes you feel like a nut, sometimes you don't. So, if you want to roll the dice on any of the investments here that we talked about today, put it put in only money you can afford to lose, up to 5% of your net worth maximum. Think of it like this. Think of it like enjoying a casino on a cruise. You know, I had fun. I speculated, and it doesn't pan out, so be it.
Yeah. And the last one is just bad investment advice. That can get personal. You know, there's a lot of things that people toss at you that you really got to be careful about. You know, I already talked about variable annuities. You got to watch out for scams when people are pitching things via text or emails, especially if it's somebody you don't know. And that old saying, if it sounds too good to be true,
It ain't.
it probably is. You know,
Mhm.
so those are the kind of things you watch out for, and watch for advice from people who aren't rich. Okay, because if what they were talking about worked, they'd be rich and they probably wouldn't be talking to you. Okay. So uh watch out for that individual stock pick that somebody whispers, oh, I know it's inside deal. And in some cases that does happen. In most cases, it doesn't. By the time it gets to you or that person you know, it's probably common knowledge on Wall Street. And if it isn't common knowledge and somebody tells you something before it happens, that's illegal. So don't, don't do that, because you could go to jail for insider trading, just like Martha Stewart did, even though she shouldn't have went to jail. That's another story. But
Right.
again, just watch out for people hawking things to you, because again, it's probably not legit.
Very, very good point, though. So, with that, let's go to the takeaways, though.
It still shows I'm backstage, but I guess I'm not.
No, you're not. I'm looking at you on the. I got you on the phone too, just to make sure.
That's a good thing.
Yep. It's crazy technologies, man. We're slave to technologies. All righty, dope. Let's go with this here. It's on me. Know where you are going. What we mean by that is that
It's
we
not.
all
I don't see it. Is it on the screen?
you're supposed to be. We talk too soon. Yeah, it's supposed to be. You don't see it on the screen. It's on the screen.
No. Okay, I don't see it. But
No,
again, I'm still backstage.
it's on the screen. Hold on, let me see. Yes, it's on the
Okay.
screen. I'm looking on my phone. It's on the screen.
Okay.
Okay, know where you were going. That's important, you all. It's important that you have a plan, you have a destination, and so before you leap, know what you're into, so you can make sure it's aligned with where you're trying to go. That's so important. Know where you're trying to go.
Yeah. Next is, every investment is not good for you. Just because somebody bought a stock and it did well doesn't mean you can buy a stock and it's going to do as well. Or somebody, you don't know what their entire situation is. So stop listening to what other people do, what other people are doing. Get investments that fit your situation.
Next, excuse me, get solid advice. It's so important. Joe talked about just listening to other people. Make sure you have people who are qualified, normally who are certified or have some kind of certification, with their name. And it's so important that you focus on those people. And it doesn't have to be a professional, qualified advisor. If it's a friend that you know that's done well, like for instance, my friend Dope, I listen to him because he's always been right. If you got a friend like Dope, telling you, get solid advice.
Yeah, next is do your homework. You know, we can't underestimate how much work it takes to be wealthy. We always talk about more money, more problems. A lot more things you have to consider, a lot more things you have to work on. There's a lot of balls moving, whether it's taxes, whether it's things you have to keep up on, whether it's the contracts to look through them to make sure you're not getting ripped off and you're minimizing fees. Do your homework. It takes work to build wealth.
Last but not least, stay the course. Stay the course. Once you get a plan, yes, you can make some adjustments along the way, but the main part is to be consistent and stay the course. Don't have those, fear of missing out or worrying about your Joneses with other people doing. Make a plan, get good advice. You know where you're going, know where you are, know where you're going, and just stay the course. And we can't emphasize that enough about staying the course, because so many people, well, a lot of people don't even have a course. But the main important thing is to make sure you just get the plan and stick to it. Stay the course. Yes, though. So with that,
What are you laughing at?
I'm just laughing at my quote for today. So, first of all, I want to wish Kitty a happy birthday, May 3rd. And Garnett, thank you for being on. My sister Nolia, my only sister, is on today. I don't know where Gloria and Linda are, but Modestine, thank you for being on. Modestine said, Modestine said, y'all hit, what did it say, Modestine? Great information. You guys hit the ball out the park tonight. Thank you. Thank you, Modestine. Great to see you. Joanne Skinner, you're always a winner. That's why they call you Joanne Skinner. What's up, Joanne? Kitty, good to see you, dearest. Garnett, so glad to have you, my ex-co-worker. And that's everybody on today, you all. So, dope. I don't know if this is.
You're scaring me, man. You're scaring me.
I'm trying not to curse, so I'm trying to alter this quote for today. But I'm just so forgive me, y'all. I'm just going to do, because it works better if I use this word. And it seems like for today, shit got to happen before you get shit right.
Are you still
on? You didn't hear that, though, and I'm not going to repeat it.
Good.
Oh, no. So anyway, y'all, have a wonderful week. We're here next week. Melody is graduating you all from the University of North Carolina this weekend. Hey, she just hit me today. She got all A's in sports science and sports medicine. She's
fantastic.
Rolling. Yes, great. So
congratulations to you, good parents. You
and Tiffany.
Congratulations. Yep. Congratulations to y'all.
Thank you. Y'all, look, have a good week, everybody. Oh, look who get on here. All late. What's up, Jimmy? Alexander. He said another great show. Thank you, my brother, and thank you for those good wizard or DM that you give me. That I check out your videos. Y'all have a good day, and peace be with y'all.